Awesome. So I guess we're going to get started. And Roland, if you could flip to the next slide, please. All right. Hi, everyone. Thank you for joining us for our CDFI Lending Policies webinar today. I'm Cindy Luxman, SVP of Development Services at OFN. I'm joined today by Barbara Ekblad, Principal and Founder of the Ekblad Group, as well as Latori Gear, CEO of Community Works. I'm going to start with some housekeeping tips and brief background info before turning it over to our presenters. In terms of housekeeping, I want to note that we are recording this webinar. We've allotted 15 minutes at the end of this webinar for audience questions. And so with that said, please feel free to submit any questions you have in the Zoom chat as they occur to you. We also encourage you to use the chat function to introduce yourselves, share comments, and interact with the other participants. And we do ask that you please remain on mute until we get to the Q&A section. And then, all right, Roland, if you can get to the next slide. And then so first, I'd like to start by acknowledging our sponsors, Capital One and Fifth Third Bank, whose funding provided us with the support to develop the resources for CDFI Growth tools and webinar series. And then next slide, please. All right, so our resources for CDFI Growth webinar series highlights new toolkits OFN has developed to support CDFI practitioners, like many of you joining us today, in maximizing organizational sustainability and impact as your organizations grow. These tools were developed in response to feedback we've received from our members that it'd be helpful to have best practices resources on a variety of topics. So we've heard that feedback, and there are currently 3 toolkits. The first is our cash management toolkit, which includes an overview guide on how to think about effective cash management, as well as 3 starter Excel tools to assist with cash flow modeling and asset liability matching. Second is our 4 essential pillars framework, which is a concise practical handbook that covers the core elements of every CDFI's business model. Last but not least is the topic of today's webinar, which is our loan policy toolkit, and that's designed to help CDFIs create, refresh, or rewrite their loan policies, and is what we're kind of going to focus on. And so while these toolkits are designed specifically for CDFI loan funds, they can be adapted for CDFI credit unions, banks, and venture funds as well. And then next slide, you can access and download the resources for Growth toolkits as they get added on CDFI Connect. So right now, all 3 of these toolkits are available. Once you log into CDFI Connect, you can navigate to the resources drop-down menu and then follow the remaining instructions noted on the slide. If you're joining us live, we're sharing direct links to all 3 toolkits in the chat shortly. And if you don't have a CDFI Connect account, you can join for free at the link noted on the slide. And then one note, since we've been getting a lot of questions related to this offline, we have been recording these webinars, and thanks to our awesome comms team, you can already access the previous 2 webinars in the series on demand, either via CDFI Connect or the OFN website. We'll be sharing links to those recordings in the chat as well, and then the recording of this webinar will be available in a few days. And then next slide, please. All right, so today's topic is our CDFI Loan Policy Toolkit. Here you'll see the components of this toolkit. It includes a loan policy guide, 3 sample loan policies that you can refer to for sector-specific examples of how to operationalize the loan policy guide for your CDFI, as well as 2 checklist templates for the SBA microloan program and a USDA intermediary relending program. I want to take a moment here to acknowledge and thank the CDFIs that allowed us to include their loan policies and checklists as samples in this toolkit. We really appreciate their willingness to open source their work so that others don't have to recreate the wheel. And 2 other things to keep in mind. First, we are planning to add additional sample policies, templates, and checklists to this toolkit over the next few months. So if you don't see an example that is directly relevant to your work now, know that we are expanding to expand the examples available. And then second, we do see all of these resources as living documents. And so we recognize that best practices evolve over time and that things like changes in accounting standards and advancements in technology may require different policies. So we do plan to update all these toolkits periodically to be responsive to changing conditions. And so with that, I'm now going to turn it over to our presenters, Barbara and Latori. Barbara's going to walk you through the highlights of this toolkit, while Latori is going to share her insights as well as lessons learned from her recent experience revising her own CDFI's loan policies. So Barbara, I'll turn it over to you.
Thank you. Can we have the next slide, please? Hello, everybody. I am super excited to be with you today and to have this guide. I just told this to Cindy, how excited I am for practitioners around the country to have this. I know from personal experience how challenged I was as a practitioner when I was trying to figure out the content of a loan policy for our team. And as I've worked across the industry over the last 10 years, I've worked with just tons of clients who've struggled with what best practice in their loan policies looks like, what their loan policy should include, what it shouldn't include, what the difference between a policy and a procedure is, all of those hard things that we have to struggle with when we're overseeing a lending function and participating in one and need those policies to reflect our work. So I really genuinely want to thank OFN for giving us this guidance for what I think the industry needs and is articulating industry standards for policies. I'm hoping this works well for you. So let's get started. Today, the section that Tori and I are going to be presenting are sections that are going to talk briefly about why a loan policy is important. I'm going to orient you to the policy guide itself, what you can expect from it, and then do a bit of an overview of each of the 8 sections that have been identified in the guide as critical to a robust loan policy. Then Tori's going to jump in and share her experience in guiding her team through the experience of revising their loan policies and give you some practical advice on to-dos, not-dos, et cetera, and how you might use this guide. And then we're going to open it up to questions and answers from folks on the session. So next slide, please. All right, so I want to orient you to the loan policy guide itself. This guide is really intended to give you actionable information, meaning information that you can use to actually rewrite your loan policy in different sections. Each of the sections of the policy guide has a bullet point list of those areas in that section of your loan function, what the policies are that you need to consider and have included. And then there's a narrative section that gives you much more detailed guidance. It defines the policy area we're talking about. It explains why it's important, and then it gives you some practical advice on things to consider and a process to use to develop that section. So this is intended to be very, very practical in terms of use. Okay, next slide, please. So why is a loan policy important? It's important because it's the framework for defining how your CDFI manages the risk of your lending function. It defines your risk tolerances. It defines the culture of risk in your organization, how you actually understand risk as an organization around credit. It assures your CDFI that it's aligned to the target market that it's serving. So these policies, when you have to think through and document your policies, it helps you make sure that you are actually serving the market that you intend to serve. It also actually reflects the skills and experience of your staff in their lending, your loan committee, as well as your board. A loan policy, this is super important because I see this way too often that it doesn't include this. It needs to include everything that happens that you have to manage policy around, from the intake, when the borrower comes to your door, all the way through everything that happens until that loan is either paid in full or charged off. So your loan policy manual needs to include not just your origination process, but also your portfolio management process for managing those active loans in your portfolio. The loan policy should be reviewed and approved by your board. And why should your board hold that responsibility? Because your lending function is one of the 2 most concentrated places of risk in your organization. Your lending portfolio, how you put loans in and into your portfolio and how you take care of them when they're in it, and your finance. Your finances of your organization. So the board should be approving your loan policy manual. Lastly, loan policies are important because they drive your staff's operational activities every day in doing their lending work. Your policy set up the opportunity for staff then to figure out how they're going to get their work done to meet those policies. So they're really at the hub, is the way I see loan policies, of everything you do in your lending function. Next slide, please. All right. Let's look at the different sections that we are commending to your consideration for being included in your policy. You should have a section on your mission and purpose of the policy itself, the mission of the organization and the lending, and the purpose of the policy around that mission. Defining your products, your loan products, articulating the policies for originating loans, putting loans together, underwriting them, and getting them to approval. The policies for your portfolio management functions, loan servicing, loan closing, et cetera. And then also policies for how you manage active credits at the credit level, your active loans at the credit level per active loan, and then how you manage risk in the portfolio and its performance writ large. We also commend your consideration a section where you talk about the intersection of the portfolio management function around loan data and loan information and the finance function. There are two places where those two areas of your CDFI work together. We're going to talk about the policies around those that you should consider. And lastly, a couple of other policies that should be in every loan policy manual. So those are the 8 sections that we're going to go through a little bit of a deeper dive on. Next. So, all right, let's start with the first section. Mission and purpose of a loan policy manual. Should it have 5 areas of consideration that we want you to think about? One is a mission statement that restates the mission of your CDFI and the lending function's role within that mission. That's what you should start your policy with. And then next, make sure that there's language in there that says that this is intended to ensure that your organization is operationalizing its lending function to serve that mission. You don't have to remember all this because it's in the policy guide, but just trying to say this to you. Okay. Second is, it needs to define the market that you're going to serve, your target market, both your geographic and or socioeconomic categories that you're serving with your work. Usually this ties to your CDFI certification. Next section is your intent of the policy. The intent there should be a statement about the fact that it's intended to guide staff, as I said earlier, in how they apply the work they do every day to meet that policy. That it articulates your tolerances of risk. The intent of this policy is to articulate my CDFI's tolerances for its risk and how we manage those risks in our work every day. So that's a section. You also want in that initial section a statement about how frequently you review your loan policy, who is responsible for the revising of that loan policy, and who is responsible for approving the revisions. So the cadence for looking at the revisions to the loan policy and who approves those loan policy revisions, typically your board of directors. Lastly, I'd like you to think about having a statement in this opening section about how you handle exceptions. Normally, you would have 2 areas of exceptions. The first is that broad area of exceptions where you have a funder who comes in and says, I want to give you this money to do this work, and it looks like A, B, and C. And you look at C and you say, C doesn't work with our loan policy. So you have to say in your loan policies, these are our policies, except for the provision that some funder covenants may supersede these policies. So you have to make some statement about how you reconcile covenants from funders that don't fit with your otherwise your standard loan policies. And then the other set of exceptions are actually exceptions to your loan policy and your own lending and cleaning up of loans and oversight of loans. How you manage those, who's responsible for that, and who has authority to oversee exception, to approve exceptions to your loan policy manual. Got it? So There are 5 sections. I'm sorry, 5 sections in this first opening section, 5 subsections: mission, market served, intent of the policy, how the policy is reviewed and revised, and then how you handle exceptions to the policy. All right, next slide, please. The next section is about the products that you deploy, how you define those products and how you manage that. So when you think about the definition of products, I really want you to go and look at your policy to make sure that your product definitions are clear, that your policies for setting and adjusting interest rates are clear, and that your provisions for developing and deploying new loans have clear parameters within your policy. Let's talk about product definition. Super important to clearly define each of the products you deploy. And the policy guide gives you these categories, but at a minimum, you're going to want to have the purpose of the loan product, the eligible borrower for that loan product, the size and range of those loans, the term and amortization range of the loan, the fees relative, the kinds of fees, not specific fees, but the kinds of fees you charge. Do you charge an application fee or not? Do you charge origination fee or not, et cetera? And then the eligible uses of that loan, those loan proceeds. Oftentimes in loan policies, you're going to see a product matrix, because it's an effective and efficient way to define your products against size and different categories of definitions. You're also going to want in this section to have a section that talks about your approach to setting interest rates and fees. And I'm going to say something here that you're going to read again when you read the guide itself. Unlike traditional financial institutions that determine pricing and fee structure of loans based on the risk profile, CDFIs don't do that. We base our rates on the spread between our cost of capital and the interest and fees generated from the loans we deploy to meet our financial sustainability goals, because that directly backs in to how you are working, how you are impacting the borrower with the price of that loan for them. And that ties to our mission. So this section should address your pricing philosophy about how you set your rates and your fees, the frequency for reviewing and setting those interest rates and fees. This is a policy level. How frequently do you review what those are? And then staff and governance bodies responsible for overseeing and approving those interest rates, the specific interest rates and fees. And remember that you need a provision in here for if your funder overrides those policies, that it's okay that you're going to follow the funder's covenants. Okay. Also, when you think about your products, you may have different strategies for setting the interest rate for and fees for different products. And lastly, highly recommend that you don't put specific interest rates and fees into your loan policy. The policy is about how you set those and change those. It's not about what they are, because invariably they'll change and then you'll be out of compliance with your loan policy and you won't remember that you are. I mean, that's the practical everyday life of this. Okay. Lastly, if you're going to be in a position where you're developing new products, it's important to have a section in your policy that tells you, gives you the bumper guards for how you do that. So first of all, when you define those, especially if you're an emerging CDFI defining your loan products and their new loan products, we would encourage you to define those, to create those to address the greatest gaps in your target market. First priorities of the biggest cries for help in your target market around capital, your product should meet those needs first. And then don't reinvent the wheel. There are a lot of amazing CDFIs out there that have done what you're doing. Are you special and unique? Yes. And are you not special and unique? Yes. It's both and. So take other people's wisdom and experience and replicate it. I know I'm not going to get this right, but the biggest compliment to somebody is if you copy them, right? I don't know what that is, but you know what I'm trying to say. There's some euphemism about that. Anyway, you get the point. Okay. When you create a new product, your policy should tell you that you're required to also define the impacts of that product. And your policy should also say the frequency, the cadence with which you review the impact of those loans, that new loan product, against the benchmarks you've set, and whether it's actually working in your target market in the way you think it is. The policy is about the cadence that you do that and that you're required to do it, not specifically what those impact metrics are. Thank you. The greatest form of flattery is imitation. There you go. Thank you to whoever gave that to me. Ryan, you're awesome. If you only knew my children, you know they'd be laughing at me right now. I never get those things right. All right, let's talk about a loan origination. Okay, this is a big part of what we do in our work every day, and it's a huge part of your loan policy manual. So loan origination. Let's start with loan eligibility. Let me back up. Here are the things that you should have in this section of your loan policy laid out right here for you. Eligibility requirements, what your application includes, including the documents required with that application, what your underwriting analysis includes, what the process for underwriting includes, your approval authorities and the process for approvals, and then the functioning of your loan committee. So this is going to take you from intake right up to a loan being approved. That's your origination process. I know many people think the origination process includes loan closings. I'm going to argue that loan closings belong in portfolio management. And so we're going to end the origination process here with loan approvals. All right. So eligibility requirements. Why is it important for your loan policy to list your eligibility requirements? It's important because it's an efficiency thing. It's important that your policies say that at the beginning, we're going to make sure you're eligible for any of our loan products fundamentally. Not that you're credit worthy of getting a loan, but that you fit in the bucket of people who actually are eligible for our lending products. So examples of this are, you're 18 years old, you have a legal photo ID, your business or development is located in the geography we serve, that your examples, you don't have any tax liens, you don't have a bankruptcy within so many months or years, etc. Those fundamental requirements that if you have to say no to one of those, you're literally, I'm sorry, not eligible for our loans, period. Okay. Eligibility requirements, clear, transparent to your borrowers as they come to the door, what your eligibility requirements are. Policy level issue. Again, you're going to need to have a caveat to that. If you have funders who give you money and want you to deploy them to somebody who otherwise doesn't fit your eligibility requirements, you need a provision in your policies for overriding those eligibility requirements for specific funder covenants. Application. Let's talk about this application. Super important that your policies say that we are going to ask for the information we need to underwrite a loan, and we're only going to ask for the information we need to underwrite a loan. When in practice, sometimes I compare underwriting criteria for my clients against everything they have in that loan application. I'm like, why are you asking these 16 other things when you don't use those to underwrite a loan? Well, it's just good to know. No, it's not good to know. It's onerous to your client. Let's get the policy to say you have to have these things in it because this is what we're going to use to underwrite a loan. And then the list of documents that have to support that. At the policy level, what's in your loan application and what are the documents that you require the borrower submit in order to be able to underwrite the loan. Add note to this, super important in practice that you're transparent with your borrowers up front about what you require of them. documents and application fee and application costs upfront. Okay. Next thing, you need a policy that talks about how you handle the confidentiality of your client's information. And you may want a specific policy about how you handle information on Social Security numbers. Make sense? And just remember, you may have to account for different applications for different products, depending on how much those products vary. So for example, if you're a CDFI that deploys both small business loans and affordable housing development loans, you're going to have a very different, not only application for each of those, but also required documents. All right. Underwriting policies. Let's talk about these. These are the meat. Sometimes I think that this is the concentrated meat of loan policy sometimes is in these underwriting guidance, right? Requirements. So those policies should draw on your experience as a CDFI and also brushed up against industry best practices. They should name specific underwriting criteria, categories of underwriting analysis that you're going to butt the information from your borrower up against that reflect the risk profile of that product. And super important, each of those criteria should be able to be measured objectively. So each criteria should be objective and measurable. I can't tell you how many times I've seen underwriting criteria that says, strong collateral, has character, fights for their business. That is not a criteria that you can objectively measure. So your underwriting criteria have to be categories that you can set benchmarks for. And those categories and the benchmarks should apply to the complexity of the risk of that loan product. Examples of objective criteria are in the guidance. I'm just going to give you an example. For example, all ones that you're familiar with: business debt service coverage ratio, global debt service coverage ratio, historical profitability of the business, owner's equity contribution, et cetera, et cetera. You can quantify each of those categories, and that's what you're doing with your policy. You're saying, here are the categories that we're going to evaluate against. It is the origination team and the portfolio management team together in the lending functions decision about what those benchmarks are. What those benchmarks are as they underwrite credits. But the policy is those criteria that you're going to underwrite against. Does that make sense? Okay. Also, who of your staff is responsible for setting those guidelines, those objective and measurable guidelines within the criteria? Collateral consideration, you should have a schedule of the values of the collateral that you are using to back to underwrite the loan. You should have a matrix of the schedules of those. And that those underwriting criteria could be put into a matrix. That's really easily used as people underwrite the loan. All right, let's talk a little bit about risk ratings in underwriting loans. A risk rating is integral in our industry to evaluating credit risk in that underwriting process. Our industry recognizes risk ratings as a tool to support underwriting of loans and then setting of reserves, the initial reserves for that loan, and then using that risk rating to actually change the reserve levels of performing and non-performing loans in your active portfolio. The most important thing about a risk rating, besides that you have one and use it, is that it too has criteria that are objective and measurable. Again, I'm going to go back to my experience as a consultant, where I see things like highly liquid collateral, 1, not so highly liquid collateral 2. And if you think I'm kidding, I'm not kidding. We really need to make sure that when we set up our risk rating, that score has criteria you can actually measure and that you have measured it against your scoring. Okay. And then the guide gives examples to you of categories, of these categories that you can use in your risk rating. And I also want you to remember that your policy should set how the risk rating is used to set those initial reserves at the closing when you book the loan into your portfolio management system. The loan policy should also have policies. You know, this is like tongue twisters. The policy should have policies for your underwriting process. Try that one. Try saying that fast. It doesn't work. Anyway, your underwriting process should also have policies behind it. And those should address certain, I would say, 3 key issues: the tools you use, the templates you use, and the due diligence steps in underwriting. They're in the guide. 3 things you need to components of the process: the tools you need, the tools you're required to use, the templates you're required to use, and the due diligence process you're required to go through to underwrite a loan. Of course, a risk rating scoring is a good example of a tool. Your credit memo is a good example of that template. Each of these should be articulated in your policy, and you can always attach them as this is what our risk rating looks like, addendum A or attachment B or whatever. And then this section needs to talk about the roles and responsibility of staff for that underwriting process. And that needs to include the process for your new loans, but it also needs to include the policy for how you handle the underwriting process for extensions, for participations, for renewals, for restructure. If you do any of those, I'm sure you all do new loans and you do restructures. Some of you might do extensions, participations, renewals. You have to address those in your policies for underwriting procedure. Staff roles and responsibilities for doing that work. And then once you've done that work, it moves to approval. So the approval authority and process needs to have clear policies as well. First of all, it needs to be clear the delegation of authority to approve loans. Usually starts with smaller loans, less risky loans with the staff. Add more risk to the loan, you go to your senior credit staff or senior management, and then it moves to your external loan committee. That's the process, and you need to clearly articulate it. An approval matrix is a really good way, again, to articulate your approval authorities for which products, for which size. The policies also need to address who has authority to change the approval process and the approval authorities. Another area that you need a policy for is what happens with a loan between the time it's approved and the time you want to close it. Sometimes something happens, changes the credit profile of that loan that's been approved. What are those things that change that need to be addressed and reapproved before it moves to the closing table? What's your policy on that? It needs to be articulated. And then remember, that's true for all the approval authorities need to include new loans, loans extensions, participations, renewals, and restructures. The approval process has to include all those types of approvals, not just for new loans. And then there are the policies about loan committee. So this is in the loan guide, guys. So in best practice, your bylaws of your organization should articulate the membership of your loan committee and its responsibilities. The loan committee should have a charter that reiterates those and talks about how the committee is going to function, the rules for its operations. Your loan policy manual should articulate in this section a restating of what the bylaws say about who's on the loan committee, how they're appointed, and what their responsibilities are. So you might want to check that. Not always in the bylaws, but it should be. Okay. The board of directors typically delegates authority to the loan committee to approve loans. True? Yes, that's what they do. So boards should not be approving loans for lots of reasons that we can get into if you ever want to email me. But for the sake of the guide, we're going to recommend that boards do not approve loans. Loan committees do approve the largest loans unless they're an exception to loan policy, and you address that in your exceptions to loan policy section. Typically, the chair of the loan committee is a member of the board of directors with credit expertise. And then the other members of your external loan committee, those members at large, have the breadth of skills and experience needed to oversee and underwrite, review the risk of the loan applications that you originate. And depending on your industry, the sector of the industry you're in, those skills and experience look different. The guide gives you examples of responsibilities of a loan committee that you want to consider putting into both your bylaws and restating in your loan policy manual. Last note, loan staff and/or consultants should not be members of your loan committee. I'm going to say this again. Loan staff and/or consultants should not be members of your loan committee. It's in the guide, and we stand by it. Right, Sindhu? Okay. I know this is controversial. At least it's controversial with my clients when I say that to them. So, all right. So that's the origination process. We've gone through intake, all the way through putting the loan package together, policies for that, policies for underwriting, not only your guidelines, how you set those by policy and also your process, but how you approve the different kinds of loans you need to approve. Remember, not just new loans, all the other kinds of loans you have to approve with active loans, okay? Let's shift to portfolio management. Thank you. Okay, 4 areas of portfolio management I want to talk about here. The first is closing and disbursement, then how you have policies for post-closing audit, file management, and loan servicing. So let's talk about closing and disbursement. You need clear requirements for closing a loan, both in the documents that need to be in the file, the legal documents and non-legal documents, and the acknowledgement documentation that covenants of the loan have been met. The covenants for the loan approval have been met. You also need evidence of pre-closing confirmation of collateral position. What's your policy on that, of confirming your collateral position before you go to the closing table? If possible, policy, if you're have a large enough CDFI, policy should include a segregation of duties between those that draft your closing documents and those that take them to the closing table. Look to the guidance on this. There's good language in the guide about this. Then you need a policy for the cadence for reviewing your legal documents, for having legal review of your closing documents to make sure they conform to state and federal statutes. And for staff who have authority to approve a loan to close. I call this the clear to close authority. So you get a loan package together. Now somebody has to say, yes, this loan file is ready to close, and you need a policy on that. You also need policies in this section on what documents you need for disbursement, who's responsible for putting the documentation together, and who's responsible for approving disbursements. Those 3 things about disbursements: documentation needed, who's responsible for putting it together, and who's responsible for approving it. Post-closing file audit, super important. maybe one of the most frequently overlooked policies in the work that I've done with my clients over these last 10 years, silence on what happens after the closing with that file. It needs to be audited so that you make sure that when it comes back from the loan closing, that all the documentation is there, and that it is accurate. Okay, I see that. Okay, I gotta hurry. Sorry, Sindhu. And then the timing for onboarding. You should have a policy for timing the onboarding of a loan and perfecting that collateral. There's a section in the guide about how you manage loan files. Remember, you have 3 kinds of loan files you have to manage: active loan files, closed loan files, and charged off loan files. There's guidance in the document about policies surrounding that and making sure that you have that clearly defined by policy. And the same is true for loan servicing. It's super important to have good policies around what you do in loan servicing. There's a list of minimum considerations that you should have in your policies about servicing loans. And again, remember that section has to articulate who's responsible, what staff is responsible for servicing the loans. Remember, when you name staff, name position, not person. The portfolio management assistant is responsible for doing this piece of loan servicing, etc. Okay. Let's switch to credit risk. Okay, so when we look at risk of active loans, there are 2 ways that you look at this. There are the loans, you look at loans at the account level by loan. How do you manage both performing and delinquent accounts at the loan level? And then the second thing that you have to look at with your active loans is how the portfolio performs as a whole and how concentrations of risk in that portfolio perform. The guide will talk you through what it means to have solid loan policies around oversight of performing loans, as well as oversight of delinquent loans. I would highly encourage you to dive into those because performing loan oversight is frequently missed in loan policy manuals. It's frequently missed, so look at those. And the guidance in delinquency management is really robust. And oftentimes we have really insufficient guidance at the policy level of how we manage delinquent loans. So I would recommend that you look into that because there's good guidance in the loan policy guide on that. Lastly, within portfolio management is this idea of oversight of the portfolio as a whole. It's very important and a really frequently missed category also in a loan policy of how you keep track of how the portfolio's performing as a whole, and not just in a moment of time, but over time. So I want you to think about this idea of the first part of that portfolio is understanding your concentrations of risk within the portfolio and the balance of those concentrations. The tolerances of the balance of those concentrations. You need to set policies for both how you determine those concentrations and how you determine your balances of those and how you adjust those balances over time as the market does certain things or you see certain concentrations of risk performing differently. The last part of this is that I want you to think about how you track the performance of the portfolio and those concentrations over time against delinquencies and defaults. It's not just enough, like a lot of CDFIs do, of saying, here's our delinquency rate, here's our default rate. What you want to know is it going up or is it going down? What is the trend of performance in your portfolio? And the way you do this is you do a 12-month rolling trend and a 3-year historical look back. The guidance in the policy is there for you to look at and see how you can articulate that. Okay, I know I'm rushing. Next slide, please. Last couple of pieces of sections for risk are these. financial interface. There are two places that a portfolio management team and the finance team get together and do work. The first place is where they reconcile the balance of the loan data in the portfolio management software with the loan data in the general ledger accounts in the financial system. That should happen monthly, and they have to get together and reconcile those, because believe it or not, every month there's some little dweeby thing that's not the same in the two accounts. So you need a policy on doing that every month, who's responsible for it, both on the staff side and on the finance side, and the timing requirements within so many days of the end of the month. The second is how you adjust and reconcile the reserves for loan losses. So your loan policy is going to say, here's how we reserve against risk ratings to reserve against risk. And it's going to calculate how much you should have in your risk in your loan loss reserve. That's a number, let's say $1 million. But your general ledger account reserve for loan losses is only $800,000. What is the policy for reconciling those? You need a policy, and the policy needs to say how frequently you do that. The staff responsible for determining the imbalance, and the approval process we would recommend from senior management and finance to the board of what the recommendation is for reconciling the difference of those. Reconcile to policy, be ahead of policy, more aggressive on reserves or less aggressive on reserves based on the financial performance of the organization and the portfolio's performance. Critical policy in your loan policy manual. It should also be in your finance policy manual, by the way, as should the portfolio reconciliation data. Last is a couple of other policies that we want you to consider putting in your loan policy manual are conflict of interest for staff and governance members of your loan committee and your board, and confidentiality, requirements of confidentiality. So that's what's in the guide around policies that go from who you are and how lending fits into your mission, all the way through to a loan is paid in full or charged off. Tori.
Thank you, Barbara. And so I know you guys are on this call are like, that's a lot of information. And Barbara is so passionate about loan policies and making sure that you start from the beginning and go all the way to the end. And I have to tell you that this will greatly help any new potential people coming into your organization to be able to quickly pick up how your lending function works. And so for me, just coming off of, or Community Works, just coming off of revising our loan policy, I really wish this toolkit had been there to begin with. And I say that because we really spent a lot of time on our loan policy, and like many CDFIs, you know, we put in our policy that we're going to review it every year, make some additional changes. But as Barbara mentioned, when a funder comes in and causes you, or not causes you, but you have this opportunity to do something new and creative, you want to have that flexibility to be able to update your loan policy. So being able to use the toolkit, especially for us around loan committee, we had to adjust our loan committee, just that specific policy, and knowing what needed to be in there would have been really helpful on the front end. Additionally, we decided, and what motivated us to go through a full review of our loan policy, just was because we've been updating every year and we hadn't had an opportunity to see if we were doing things that were industry standards, right? And so it would have been nice for us to have that checklist up front to be able to go through and make sure that we had an internal audit done, and we had, I'm sorry, can you go to the next screen? I apologize. Yes, so making sure that we had an internal audit done so that we could see what was in there, what wasn't in there, and things that we may be able to address and change internally. And I have to say, as Barbara was going through a lot of what you were talking about, I mean, what she was talking about, and CDFIs who were doing things this way, she was kind of referring to us. She didn't say it, but she was referring to some of the things that we had in our policy that shouldn't have been in there, especially making sure that it's policy and not procedures, right? The procedures happen outside of that. And when you get ready to truly go through a loan policy revision, please don't think that it's going to take a month or two to do, because the work that we do as CDFIs is truly intentional, and it really takes a lot of time to get your team around the table, whether that's financial management, whether that's portfolio management, whether that's the lending team, and being able to come together and all agree that this is how we're doing it, this is how it needs to be done, this is what's going to help our target market and the clients that we are trying to serve to fulfill our mission. And I have to say, we started out at 6 months. We said the project was supposed to be 6 months, and it took us a year. Because in addition to reviewing our loan policies and updating them, you still had your day-to-day work, right? So make sure that you know that it's going to take a lot of staff capacity to be able to do a full overhaul on your policies. And what your consultants can add and will not be able to do for you. I know we talked about flattery, right? So we borrow some of our some of our CDFI partners tips from their loan policy. But again, you need to make sure that when you're pulling those, definitely use the guide, because the guide is very clear and about what needs to go in there and what doesn't. But when you're using the guide, it would, using a consultant, you need to make sure that and know that they are not going to just write your loan policy. I mean, they are a thought partner with you in making sure that everything that you need to have in your loan policy is there, and even questioning you about how you do things. And for us, it was a lot of we're doing it, but it's not written down. When you talk about the portfolio quality review, we were doing some of it, but not all of it. And so the consultant is really that thought partner and can guide you to be able to create a very robust loan policy, which is what we came up to have, and very happy for that. Again, you need to make sure that everyone around the table is able to be in agreement about what needs to be in that loan policy, and then also making sure that the board has reviewed it and has approved it. Right. And I saw in the comments that there were 1 or 2 people who were like, well, we're just a 2-person operation. That's fine. You're going to grow, but you still need to have these key items in your loan policy so that people can clearly understand what you're trying to accomplish and how you are helping to serve your target market. And I'll stop there.
Awesome. Thank you, Tori and Barbara. So we have about 5 minutes left in our official kind of webinar. And so what I'm going to do right now is actually turn straight over to Q&A. And so we have some questions that we've gotten already. And so I guess to start, I mean, Tori, you kind of got to this a little bit, but for a smaller team, Barbara, Tori, kind of like, how would you say that people should be thinking about this, right? Like kind of like loan policies talk about a lot of different roles or kind of like things people can do. How would you kind of, what recommendations do you have for smaller teams and startup CDFIs when it comes to thinking through these loan policies?
Tori, do you want to respond or do you want me to?
You can start. Is that
You
okay?
sure? Okay. What I would say to you is the loan policies predominantly are not who, but what. Like, what is the policy around this? What are the bumper guards for risk around this? How do we manage this? And then you can assign responsibilities for it. But as your organization grows and you revisit those loan policies, you can begin to build out responsibilities. At the very beginning of this, I said the policies need to both articulate the culture of your organization and how you understand risk. And that really speaks to different size organizations as well, how you manage that risk. What is the policy for this? Oftentimes in smaller CDFIs, you require external support for it within your policies, to have other eyes on things or to do parts of what you're doing. And the policy needs to say they're responsible for these different sections. So you can say that the most important thing is what's your policy, and then you can talk about who's responsible for it. Tori, what would you add?
I agree. I agree. And starting out as a very small CDFI, everyone was doing everything, but making sure that we had those key policies in place was very important for the organization.
And then we got a question around timing. And so like, how often should CDFIs be updating their loan policy, whether it's yearly or only when they offer a new product? And then I guess it's also like, if you can include your commentary, right? Like, how do you know when it's time to change your loan policies? Like, what are the indicators? Like, so in the chat very astutely mentioned that kind of like they were recognizing that their policies weren't reflective of there was a lot of exceptions, right? And that's obviously a great signal. But when should you, like, what are the signals for you, right? When you're like, it's time to change this.
Okay, I'm going to use a little humor here, so indulge me. The first time you should look at auditing and revising your loan policies is if you don't know where they are. And I'm not kidding about that, because sometimes I'm asked to go into and do an assessment of a CDFI's operations, like their lending operations. And I ask them for a set of documents, and one is the loan policy, and they say they can't find it. So if you can't find your loan policy, it's the first indicator that you need to revise it, that you need to bring it out, dust it off, look at it, what it says, and then go through the process of updating it. And I don't mean that, I'm not trying to be snarky about this. I really mean this. Second is, it should be annually, except in overriding circumstances. And there are two kinds of overriding circumstances. One, something has materially changed in how you lend. Like, oh, we acquired a small loan fund that has been integrated into our CDFI. Oh, we got to go look at what that means for our loan policies. That's a big example. But there are other examples of it. The economy is going to heck in a handbasket. We need to go look at our loan policies and see what that means for them. Something material that impacts your lending function, that you say, we got to make sure our policies align with this new change in risk. The second is if you have a specific circumstance like Community Works had, where it had a couple of funders that came in and said, we want to give you a lot of money, but we want specific loan committees to approve the loans for the money we're going to give you. They had to go back to that section of their loan policy manual and say, what do we need to change about how our loan committee is structured to address the requirements of these funders? And it's not just enough to say, funders override our policies. It was a material change to how their loan committee was actually structured. And so those specific areas of your policy that may have something happen where you've got to go to look at that specific area and change it, update it. So those are the three things I would say about cadence for revising your loan policy manual. Yearly, if nothing else.
And we're just about out of time, so I will do one more question, which is like, someone asked about securing information for data and like optional information like race and gender, et cetera, and is like, should all of that be required internally?
That sounds like a mighty fine confidentiality requirement to me.
Perfect. All right. Does anyone else have any burning questions that they would like answered? If you're welcome to hop off mute and ask them, if we have a little bit of time to stay on. Otherwise, Roland, can you flip to the next slide? Awesome. So thank you, Barbara Latore, for your excellent kind of contributions and like this awesome webinar today and sharing all this information, your expertise. And thank you to everyone for joining us over the last 3 weeks. It's been great to kind of see many familiar faces and names and to hear your great feedback. And I will say that this is kind of just the start of a lot of different resources and training that we're putting together. So if you'll be at our conference in New York in a few weeks, you'll get to hear from us about our new development services team that's being funded by a new city grant. Otherwise, keep an eye out for more information that's coming soon. And have a great afternoon, everyone.